I almost didn't make this video. I told myself this might just be another routine pullback. Markets dip all the time, assets rotate, fear flares up, then fades. That's how cycles work. Silver falls a bit, Bitcoin slips. Commentators rush to label it a healthy correction. End of story. That's what I wanted to believe, but the more I looked at what was happening beneath the surface, the more uneasy I became, because this doesn't feel like an ordinary dip. It feels like a message. Silver and Bitcoin don't usually slide together without a reason. They attract different types of investors, serve different narratives, and respond to different headlines. When they move in the same direction at the same time, it usually signals something larger than a chart pattern. At first glance, the explanations seem obvious. Stronger dollar, shifting rate expectations, risk-off sentiment creeping back into markets. Those reasons sound logical. They always do. But they don't explain why the reaction feels sharper, faster, and more emotional than expected. Something deeper is happening. Most people are focused on the price action. Smart investors are focused on behavior. Silver isn't just declining. It's losing momentum at the same time physical demand remains tight. Bitcoin isn't just pulling back. It's doing so while long-term holders remain unusually calm. That disconnect matters, because price alone never tells the full story. Markets don't move on numbers alone. They move on positioning, and right now positioning is shifting. For months, silver was quietly regaining attention. Not hype-driven attention, but cautious accumulation. The kind that doesn't make headlines. The kind that suggests preparation rather than speculation. Bitcoin, meanwhile, had rebuilt confidence after previous cycles, drawing in investors who weren't chasing quick profits, but long-term exposure. Now both are sliding, and that's exactly what has people confused. But confusion is often where opportunity forms. This isn't a mass exit. It's a test. Corrections like this don't scare experienced investors. They study them. They look for who's panicking and who's not. They watch volume. They track what gets sold aggressively and what quietly finds buyers underneath the surface. Right now, fear is loud. Conviction is quiet. Silver's decline is shaking out weak hands, those who bought late, expecting immediate follow-through. Bitcoin's slide is flushing leverage, positions that were never meant to last through volatility. This is what markets do before choosing a direction. And yet, most headlines treat this as a warning sign. Silver is breaking down. Bitcoin momentum is fading. Risk assets under pressure. Those statements aren't wrong, but they're incomplete, because smart investors aren't asking, why is price falling? They're asking, who is selling and who is not. That distinction matters. In silver, physical buyers haven't disappeared. Industrial demand hasn't collapsed. Supply hasn't suddenly surged. What's fading is speculative confidence, not fundamental relevance. That's an important difference, and it's one many people miss. In Bitcoin, the same pattern is emerging. Short-term traders are exiting. Long-term holders are barely moving. That's not distribution, that's rotation. And rotation often happens quietly, right when fear feels loudest. This is where patience separates outcomes. Most investors are conditioned to react. Red candles trigger emotion. Losses feel urgent. But seasoned participants know that moments like this aren't about speed, they're about positioning. Markets are recalibrating expectations. Silver had moved ahead of certainty. Bitcoin had priced in optimism. Now both are being forced to justify their value in an environment where liquidity is tightening and narratives are being questioned. That doesn't mean they're broken, it means they're being tested. And tests reveal strength or weakness over time, not overnight. Another factor most people overlook is timing. This slide isn't happening during panic, it's happening during hesitation. That's far more important. Panic marks endings. Hesitation marks transitions. Investors are no longer blindly chasing upside, but they're not abandoning ship either. They're reassessing, waiting, watching how markets respond to stress instead of momentum. That's exactly what smart money does. They don't chase breakouts when optimism is high. They don't sell bottoms when fear spikes. They step in when narratives fracture and clarity disappears. This moment fits that pattern uncomfortably well. Silver's pullback is forcing investors to ask whether they believe in its long-term role or just its short-term momentum. Bitcoin's slide is doing the same, separating those who understand volatility from those who fear it, and that separation always happens before the next major move. What makes this moment even more interesting is what isn't happening. There's no systemic panic, no forced liquidation across all markets, no sudden collapse in liquidity. Instead, there's selective pressure, targeting assets that had grown confident. That's deliberate, and it's telling. Smart investors don't need everything to crash to act. They look for stress fractures, small breaks that reveal where confidence was weakest. That's where repricing begins. So while most people see silver and Bitcoin sliding and assume danger, experienced investors see information. They see a market asking hard questions about value, timing, and patience. Those questions don't get answered in a day, they get answered in positioning. This is the part of the cycle where noise dominates headlines, but strategy dominates outcomes, where those who act emotionally hand opportunities to those who don't. And that's why this moment matters more than it appears, because corrections don't end stories. They clarify them. What smart investors are doing right now looks boring from the outside. They aren't making dramatic calls. They aren't posting confident predictions. They aren't rushing to declare that the top is in or that the bottom has arrived. Instead, they're observing, adjusting, letting the market reveal its hand before committing further. That patience is intentional, because moments like this aren't about guessing the next move. They're about understanding the environment that produced the move in the first place. Silver's slide is forcing a reset in expectations. It's reminding participants that even assets with strong long-term narratives don't move in straight lines. The recent pullback isn't erasing the structural forces behind silver. It's testing how much of the recent demand was conviction and how much was momentum. That distinction matters. Conviction stays, momentum leaves, and what remains after momentum exits tells you far more than any headline ever will. Bitcoin's behavior reinforces this point. Despite the drop, there's no widespread capitulation. Long-term holders aren't flooding exits. Network activity hasn't collapsed. What's unwinding is leverage, positions built on the assumption that volatility had disappeared. That assumption is always temporary. Smart investors expect volatility. They plan for it. They don't confuse turbulence with failure. This is also why they're not treating this as a binary moment. They're not all in or all out. They're scaling, reducing exposure where risk no longer makes sense, and quietly increasing it where fear is mispricing assets. That process isn't exciting, but it's effective. Another key difference is time horizon. Most retail participants focus on what happens next week or next month. Smart investors focus on what happens after uncertainty peaks. They understand that markets rarely reward impatience during transitions. Right now, we're in a transition. Liquidity is tighter. Narratives are weaker. Confidence is uneven. That combination produces choppy, frustrating markets, exactly the kind that push emotional investors out while allowing disciplined ones to build positions quietly. Silver and Bitcoin are both reflecting that environment. They aren't collapsing, they aren't breaking out, they're adjusting. And adjustments are where capital shifts hands. This is also where risk management becomes more important than prediction. Smart investors aren't trying to call the exact bottom. They're defining levels, managing exposure, and staying flexible. They accept that being early is often indistinguishable from being wrong until it isn't. What they're avoiding is certainty. Certainty is dangerous in markets like this. It leads to oversized positions and emotional decisions. Instead, they're operating with probabilities, not narratives. That's a crucial difference. While headlines focus on what's falling, smart investors focus on what's holding. They watch which assets recover quickly after selling pressure. They note where buyers consistently step in. Those signals matter far more than intraday volatility. In silver, physical demand and long-term accumulation haven't vanished. In Bitcoin, long-term conviction remains intact beneath the surface. Those are not signs of collapse, they're signs of digestion. Digestion is uncomfortable, it's slow, and it tests patience, but it's also necessary. Markets that don't correct don't sustain. Pullbacks reset leverage, shake out excess optimism, and create the conditions for the next move, whatever direction that may be. This is why experienced investors aren't panicking. They've seen this phase before. They know that the most dangerous moments aren't when prices fall, but when confidence becomes unanimous. Right now, confidence is fractured. That's healthy. It means the market is thinking again. Silver and Bitcoin sliding together isn't a coincidence. It's a reflection of broader hesitation. Investors are reassessing risk, questioning assumptions, and deciding what truly matters in a more uncertain environment. Those decisions take time. And during that time, the loudest voices are usually the least prepared. The smartest moves right now won't make headlines. They'll only be obvious in hindsight. Gradual accumulation, careful reduction, patience instead of prediction. Because when the next clear trend emerges, it won't announce itself loudly. It will begin quietly, while most people are still distracted by what just happened. That's how smart investors stay ahead. Not by reacting to every move, but by understanding what the move is really saying.